Writing. Book number 5, Beating the Street. Author, Peter Lynch. This video is an original educational documentary inspired by Beating the Street. It is not a reading, reproduction, or substitute for the book. Every section uses original wording, analysis, and commentary. We include historical context and practical examples. The purpose of this video is to help viewers understand investing concepts. This is not financial advice, and we do not recommend any investment. Investing always involves uncertainty and risk. Past performance does not guarantee future results, and no strategy can eliminate the possibility of loss. Many people know Peter Lynch because of One Up on Wall Street. After that book became widely read, investors continued asking questions. How do professionals actually research companies? How do they organize ideas? How do they avoid common mistakes? How should individual investors evaluate businesses in a constantly changing market? Lynch wrote this book to expand his philosophy. Rather than shortcuts or secret formulas, this book emphasizes observation, careful research, disciplined thinking, and patience. It reminds readers that successful investing is the result of preparation, not prediction. Today we'll examine the book's major ideas. We'll explore how they can be interpreted in today's markets and discuss both their strengths and their limitations. Chapter 1. Investing begins long before you buy a stock. Many believe investing starts when they place an order. Peter Lynch saw it differently. He believed investing begins much earlier, with curiosity. Research starts in everyday life. A restaurant that continues attracting customers, a medical device becoming widely adopted, a software platform used across industries, a retailer expanding into new markets. These observations are not investment decisions. They are starting points for investigation. The difference is important. Observation creates ideas. Research tests those ideas. Evidence supports or challenges them. Thoughtful investing requires moving through each step carefully. Chapter 2. The business matters more than the stock price. Before asking what the stock price is doing, ask what the business is doing. Is the company growing responsibly? Are customers satisfied? Does it generate sustainable profits? Can management adapt to change? How intense is competition? Strong businesses and stock performance are not always the same over short periods. Fundamentals provide context price alone cannot. Chapter 3. Research is a continuous process. Some investors perform research only before buying. Professionals continue after. Companies release quarterly earnings. Industries evolve. Competitors introduce new products. Consumer preferences change. Economic conditions shift. Good research is an ongoing process. Changing your opinion when evidence changes is part of disciplined decision-making. Chapter 4. Understanding the numbers behind the story. Stories attract attention. Financial data provides evidence. Lynch encouraged connecting the narrative with performance. Is revenue growing consistently? Are profit margins improving? How much debt? Is cash flow supporting earnings? Is management investing for future growth? Numbers contribute to a broader understanding. Chapter 5. Patience can be an advantage. Markets reward speed, but thoughtful analysis still requires time. Lynch argued for patience. Individual investors may possess one advantage over institutions. They aren't required to make immediate decisions. Patience allows reflection. Waiting is not inactivity. Waiting can be part of a disciplined investment process. Chapter 6. Mistakes are part of investing. No investor makes perfect decisions. Markets are uncertain. Unexpected events occur. Industries change. Companies disappoint. The important question is whether investors learn from them. Keeping records and reviewing assumptions can improve future judgment. Chapter 7. Emotional discipline. Markets experience periods of optimism and fear. News headlines can amplify both emotions. Distinguish between market excitement and business fundamentals. Developing a consistent framework may help reduce emotional reactions. Chapter 8. Thinking like a long-term owner. Buying shares represents partial ownership. This perspective changes many decisions. Instead of asking, "Can I sell next week?" ask, "Would I want to own this in several years if fundamentals remain healthy?" This mindset encourages evaluating businesses rather than simply following market momentum. Final summary: Beating the Street. The book emphasizes research, observation, analysis, patience, and independent thinking. It does not claim investing is easy. Instead, it encourages improving decisions through preparation and curiosity. Every investor should consider their own objectives and risk. Understanding how experienced investors approach analysis provides valuable insight into the decision-making process. Thank you for watching. If you enjoy thoughtful discussions about investing and financial history, consider subscribing for future educational documentaries at sayed.growth documentaries.